What's up, guys? It's Sam here, and I wanted to talk about options trading with Robinhood. So, if you're not familiar with Robinhood, Robinhood is a completely free brokerage platform where there's no cost for trading of any sort, including trading options. However, I just started playing around, so I've traded option. I've enjoyed playing around with options for a while now. And one of the things that is common around people in general, whether they're in the finance industry or financial services or just in business in general, they think that options are very risky, which anything can be risky if you don't know what the fuck you're doing. So I wanted to talk a little bit about that, using one of the examples of the positions that I have open. So, before I do that, make sure you press that thumbs up button. Okay, so what options are? Basically, there's a put and there's a call. Those are two different types of options. And then within each one of those, so calls, you can buy it or you can sell it. And then with puts, you can buy it or you can sell it. And if you were to sell it, then you make money if it moves in the opposite direction of the purchaser of it making money. So, for example, if it was a call, and you purchased a call from me, right, on Tesla, and it was a call at the current market price. So there was a call at 270, and I sold it to you. You purchased it for $4 or something. And then that gives me a break even, right, from 275, roughly. We'll say it was 275 is the share price, and that's the expiration price, so it's at the money. If the price goes up to 279, I just break even. I don't make anything. But if it goes up to, say, 300, then you make out and I lose, inversely, right? It's like a seesaw. At that 279 is the break even point. So everything above that, so if it goes from 279 to 280, you make $1, I lose $1. And people think that is very risky, but there's many things you can do to just limit that risk. So I wanted to talk about a couple of those things and what I do. So with this right here, so I have a put credit spread for Tesla. And I sold the 275 and I purchased the 267.50 for expiration on the 22nd. Today is 3/18. So it moved against me this morning. So I'm down in this position about like $100, $98. I'm down as of today just on this one position. And because the current share price I think is around 270, so it's moved against me, right? So the credit I took in on this was $2.88. So that means 275. If you take 275 and you subtract, let's see, 275 minus 2.88, my break even is $272.12. So because with Robinhood there's no trading costs, so my break even is lower than somebody who does have a trading cost. Like if you're using a different trading platform that you have to pay to trade, meaning like last time the TD Ameritrade or like Charles Schwab or some of these other places where you can, I think Charles Schwab owns option something or whatever, Express or option something, and it costs money to trade. So by not having any cost associated with options trading, you actually have a lower break even, which is reduction in risk for me. So it's below 272.12, right? It's below $272.12. It's at like 270 roughly. And that means that I'm out $202.12, right? However, that is just today's position. There's still time decay in the position. So that's theta, and that's one of the Greeks. So what time decay is there's, I think, about 6 different factors that go into pricing of an option if you're using the Black-Scholes model. Black-Scholes of Merton, depending on whose textbook you want to look at. But those were 3 lecturers. I think 2 of them were out of the University of Chicago, and I don't remember where the other one was out of, or well, maybe all 3 were out of Chicago. But there's 6 factors that go into it. And if you look at the time decay, which is theta, I'm going to show you this. The time decay for an option looks something in the neighborhood like this. So, right? So if you look at the bottom axis, that's time, right? And this is the value, the time value on the option. So if you take a look at this, so that's the time value on the option. Hopefully you can see this and it's not inverse, otherwise you'll have to hold up a mirror to be able to watch the video. And the other one's time. So that means as time goes on, that portion, right, say at the beginning over here, it represents, say, 10% or 20% of the value of the option. Excuse me, as we come out here, the time decay of it increases, the pace of it increases. So that is why I like weekly options. And so that still has the potential for this loss to go away before Friday. And the other thing is, when the position moves against you, a lot of the time you can roll the position, which means, and I only like to roll positions mainly if I can take in a credit. So as we mentioned, right, 275 minus what I got in, the $2.88, puts my break even at $272.12. So, for example, anything below 275, I lose money. It starts to take away from the credit that I got. So the break even is actually 272 and 12 cents. Right? So now if I were to take this position, so it's the 275 for Friday, the put, and the 267.50 for Friday, I purchased that for the spread. Now, rolling that means you just roll the date out for the time. And I generally only like to do that if I can take in a credit. Now, what that means is, right, these represent the, well, first of all, so the only maximum amount of money that I can lose on this position, I think, is like $750 or something. It's the difference between the 2 strike prices, which is the 275 and the 267. So if you took that 275 minus 267, the 267.50, and that's 275 minus 267.5, that's $750, right? You're like $7.50, but each option contract is based on 100 shares, so of the underlying. So it's $750 that I could lose on that position, and that's the maximum I can amount to lose. So people think it's super risky, but the maximum I can lose on this is $750, and that actually doesn't factor in the premium that I took in. So if you factor the premium that I took in, the maximum I can lose on this position is $462, which obviously you don't want to take a loss anyway. But what you can do before you even get there, as it moves closer to Friday, as you get closer to Friday and this starts to decay much more rapidly, a lot of the time, from my experience, you're able to roll that to the following week. So that's going to be 329. So these same positions, I could close out and open up the following week. So you just roll them over in one order. You purchase the 275 put for 322. You sell the 267.50 for the 22nd. So that closes out this position, and you simultaneously open it up for next Friday. And during that, you actually take a credit in. So the only way I like to do that is when I can get a credit, which just means I get more money from that. So it might be 10, it might be $50 or something. Because remember, whatever 10 cents or 50 cents, multiply that times 100, and that gives you your total amount of credit on the position. And then what that ends up doing is, right, so say if I got 12 cents in, 12 cents of credit. So what that ends up doing is changing my break even right here. So then we can take out 12 more cents here. Oh man, look at that baller. So the break even, did you see that? I drew that upside down. So the break even changes to 272. So I have a lower break even. And depending on where the share price is, I can continue to do this until hopefully the share price goes up, right? Once it goes up above 272, then I can close out that position. But throughout this whole time, I can continue. So say this happens this week, right? By Friday, I'm still a losing position, but I can roll it over for 12 cents, right? And then closer to the following Friday, the 29th of March, it's still hovering around 270, right? And I'm still going to lose money. So if I can if I'm able to roll it to the following week and say I can get a 20 cent credit on that, right? So now we take the 272 back over here. We take the 272 over to here, and over to this side, minus the 20 cents, and now our break even is 271 and 80 cents. So continuing to do this until you put yourself in a position where you can make money on it, for me, just helps. Yes, the money is tied up, so you can't put it somewhere else. So you have to consider the opportunity cost, but you also can continue taking it in credit throughout this whole entire time. So that helps reduce the risk in the position on this entire position. Anyways, I hope this was slightly helpful and not extremely confusing. Basically, on any options position, you can limit the amount of risk involved. First of all, if you're purchasing options, that's all you're doing is just, you don't have any risk involved other than the capital that you put out to purchase the options. Meaning, if you were to purchase a call for $1, that's actually $100 because times 100 shares. So if you were purchasing for $1, your total risk is that $100. That's it. You're not going to lose any more. You just have the potential to make more. Same thing with a put. If you purchase a put for $1, the total amount of capital you can use is $1. I like to do it in the inverse of that, because if you look at the actual data, the vast majority of options are never ever exercised. Meaning, they're never exercised like somebody telling me this is in the money. So then they tell me that they want the share price, and I actually have to deliver the shares. So I never have to actually worry. There's still that probability of that happening, but it's very, very low if you look at empirical data on that. Anyways, hope this was helpful. If you guys enjoyed this video, make sure you press this thumbs up button. Also, if you want to check out Robinhood, there's a link in the description. If you do use Robinhood and you use that link, you get a free share of stock. I also get a free share of stock. I actually pulled it up so I would have this information. If you sign up, everybody gets a free share of stock. There is a 1 in 70 chance that you'll get one of these four: GE, Snap, Annaly, Capital. If you were to sign up, you'd get one of those. I got Sirius XM, and that was $6 for somebody signing up. Then there's a lower probability chance of you getting Berkshire Hathaway, Apple, or Microsoft. There's about 150 to 1, meaning if you have friends sign up after you sign up, then you have a chance of getting a free share. So you get a free share, and I would get a free share of one of these things. Anyways, if you guys have any questions, leave them down below. Reach out to me on Instagram. Link will be down below for YouTube or up above on Facebook. Appreciate you guys.